In this video, we talk about how does the stock market work? The stock market helps companies raise money to fund operations by selling shares of stock, and it creates and sustains wealth for individual investors. Companies raise money on the stock market by selling ownership stakes to investors. These equity stakes are known as shares of stock. By listing shares for sale on the stock exchanges that make up the stock market, companies get access to the capital they need to operate and expand their businesses without having to take on debt. In exchange for the privilege of selling stock to the public, companies are required to disclose information and give shareholders a say in how their businesses are run. Investors benefit by exchanging their money for shares on the stock market, as companies put that money to work growing and expanding their businesses. Investors reap the benefits as their shares of stock become more valuable over time, leading to capital gains. In addition, companies pay dividends to their shareholders as their profits grow. The performances of individual stocks vary widely over time, but taken as a whole, the stock market has historically rewarded investors with average annual returns of around 10%, making it one of the most reliable ways of growing your money. Stock market vs. stock exchange. Although the terms are used interchangeably, the stock market is not the same as a stock exchange. Think of a stock exchange as a part of a whole. The stock market comprises many stock exchanges, such as the NASDAQ or New York Stock Exchange in the US. When people talk about how the stock market is performing, they mean the thousands of public companies listed on multiple stock exchanges. And more generally, the stock market can be thought of as encompassing a very broad universe of bonds, mutual funds, exchange-traded funds, and other securities beyond just stocks. Stock market supply and demand. The stock market also offers a fascinating example of the laws of supply and demand at work in real time. For every stock transaction, there must be a buyer and a seller. Because of the immutable laws of supply and demand, if there are more buyers for a specific stock than there are sellers of it, the stock price will trend up. Conversely, if there are more sellers of the stock than buyers, the price will trend down. The bid-ask or bid-offer spread, the difference between the bid price for a stock and its ask or offer price, represents the difference between the highest price that a buyer is willing to pay or bid for a stock and the lowest price at which a seller is offering the stock. A trade transaction occurs either when a buyer accepts the asking price or a seller takes the bid price. If buyers outnumber sellers, they may be willing to raise their bids to acquire the stock. Sellers will, therefore, ask higher prices for it, ratcheting the price up. If sellers outnumber buyers, they may be willing to accept lower offers for the stock, while buyers will also lower their bids, effectively forcing the price down. Seeing a very broad universe of bonds, mutual funds, exchange-traded funds, ETFs, and other securities beyond just stocks. How to invest in the stock market. If you want to invest in the stock market, the process to get started is easier than you think. Number 1. Decide what kind of account you want to open. From retirement savings to college savings, from short-term goals to long, there really is an investment account for everything. Number 2. Open a brokerage account. Once you've decided what kind of account you want, you're ready to open an account at a provider called a brokerage. When choosing a company, consider their fees and available investment options. Number 3. Deposit money. To get started, you need to make an initial deposit. You can also set up recurring deposits to automate your investments going forward. Number 4. Choose your investments. Once your account is open, you can buy and sell securities. You can opt for individual stocks and bonds or mutual funds, index funds, and exchange-traded funds, ETFs, that contain hundreds of individual securities. Many experts recommend a diversified fund-based approach to minimize the risk any one bad investment loses you money. Number 5. Purchase your investments. Once you've settled on what you want to buy, simply enter the ticker symbol in the buy field and indicate how many shares you want to buy. So guys, that was it for this video. What did you think about our video? Let us know in the comment section below. If you are new to our channel, be sure to subscribe and ring that notification bell to get notified about our latest videos. Thanks for watching.